guess, Lisa, you give me your input as well. I'd love your perspective. It still feels like the consensus view is this Fed backs away in September or maybe shortly thereafter. That seems to be the consensus position. I still don't understand the threshold that allows the Federal Reserve to actually make that decision.
The consensus, in my opinion, is a very quiet, unspoken transitory, that there are going to be these rollover effects that are going to bring inflation down naturally, that will help the Fed back away and will give them more of a legitimate reason to not go as far and fast as Bill Dudley is expecting. Whether they are right, whether we get that supply overdue or anything like that that could bring some of the prices down naturally remains to be seen.
So many people, Tom, just believe this story just won't persist. It can't carry on.
Well, yeah, okay, that's what they say. I mean,
That's what
you
they
look
say.
at hydrocarbons, and as I said, they're at a 123. I forget where we are on Brent crude, 124 right now, rounded up. Do we go to 134, which no one understands, or do we go back down to 114? To me, that's the key emotion. John, I want to emphasize this, and this has to do with when we invented surveillance. The public is in the here and now, and that's going to be the inflation report tomorrow that President Biden and everyone else has to deal with. The street is in the expected. We are always looking out to the expected, and it's two different worlds, the global Wall Street world, John, and the fill it up at the pump and Fargo world.
Just to be clear, to clear this up, Tom, when we invented surveillance, were we all wearing ties?
No, we were not wearing ties.
Everybody wants just some evidence that you did once wear a tie.
The last time I wore a tie on the show at Bloomberg was with the set designer for Mad Men.
Yeah?
Yeah, they had a tie, special tie.
Oh, so you wore a skinny tie.
I wore a skinny tie just
Very
for
cool.
a moment.
And your thoughts on that skinny tie?
It's back me out.
No, they said, you're no John Hamm.
Is that what they said? Futures, positive. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
If you can, carve out a little bit of time in 45 minutes. We'll catch up with Julian Emmanuel of Evercore, and he's made a move from 4,800 down to 4,300 on the S&P. That's his base case. We closed yesterday at about 41.15-ish. His bear case is 2,900 on the S&P. We'll catch up with him a little bit later. Equity futures positive 0.5% as the week really gets underway with an ECB decision in 15 minutes' time. On to tomorrow with CPI on deck. Let's take a look at Treasuries going into that. Pretty stable, unchanged on a 10-year yield, in and around 3% for the last couple of days. Right now unchanged at 3.02, 15%. That's the yield on a 10-year, unchanged. Euro-dollar unchanged too going into the ECB. So let's take a look at Europe. Euro-dollar 103.50, the low of the year. That was the middle of May. Right now 107.22, basically unchanged on that currency pair going into this call. But the ECB faces some contradictory goals. They don't want the euro to get too weak. At the same time, they don't want yields to get too high and spreads to get too wide. And Lisa, we often talk about Goldilocks, not too hot, not too cold, just right. I'm not sure what just right is in Europe right now because they face a problem.
They have to thread a needle in a scenario that is a basic hurricane. They're dealing with so many different variables and trying to get it right. How does this bleed into the euro? If they raise rates more, does that mean a weaker euro because that will slow growth? Or could that potentially mean a stronger euro? I have not gotten an answer, and neither of you. We've been asking it for a long time.
The Bank of England is living this right now. The Bank of England is living it. They've had to raise their inflation forecast, drop their growth forecast. Yeah. Will we see a repeat act, Tom, in about an hour's time when we hear from President Lagarde?
And from Laurence Boone yesterday, the UK view from OECD was jaw-dropping how weak that was. John, this is a really important point that the spread market to me is more important in Europe because it's so politically non-homogeneous. It's just, I can't emphasize enough, we're not talking enough about the politics that Lagarde has to face.
And it's the difference between the Federal Reserve and
Huge.
Europe.
Yeah.
You're looking at different markets. Chairman Powell doesn't have to juggle BTPs, right, the Italian debt market. And Lisa, let's just finish on that. Periphery, spreads, they've widened out. They were inside 100 basis points last September. Now they're at about 200. Are we getting to that kind of level where this ECB starts to get just a little bit more concerned?
Perhaps, and they clearly are aware of this. And I remember when Christine Lagarde said that she wasn't there to close the gap, and then she quickly reverted and said that she was there to close the gap. How much can they then target some sort of program? Because they cannot back away from addressing inflation wholesale simply because of the periphery. There has to be a more nuanced approach.
What do they do with the balance sheet? Let's find out in a news conference a little bit later. The decision about 13 minutes away. That's the cross-asset price action. Let's get some single names, some movers. We can say good morning to Romain. Good morning, Romain.
Hey, good morning, John. A relatively quiet day here in the U.S. pre-market. Tesla shares one of the more notable gainers of the day, up about 3.5%. This on the back of that data out of China showing that the Shanghai factory that Tesla has actually did pump out about 30,000 cars in the most recent month. Now, that was a huge drawdown from what this factory was used to putting out in the 60 to 70,000 range. But given the lockdowns and all the disruptions going on over there because of COVID, a lot of people seem to be applauding this. We'll see if this trend actually continues into June, July, and beyond, but nevertheless, some optimism there for Tesla. A little bit earlier, we had seen some optimism for a lot of the Chinese tech names. This is largely on the back of various reports over the last few days that China appeared to be easing a lot of the restrictions on some of those tech companies, allowing new video games, and in the reporting by Bloomberg today is that it was actually potentially going to allow Ant Group to go forward with that IPO, of course, that was scuttled very famously a couple of years ago. We should point out that the securities regulators over there in China did put out a statement in response to that report saying that they are not considering that, though they are open to some degree of relistings of some of these companies. Nevertheless, Alibaba shares, which had been higher in the pre-market, dropped about 5%, now down about 1.5% here in the U.S. The ADRs of Bilibili, they're still down pretty significantly, down about 10%, this after rallying yesterday by a significant margin. Flip it up real quick, a few other names to keep an eye on. There is some optimism here in the U.S. Caterpillar shares setting up for what could be a 7th straight day of gains. Those shares higher by about 0.9%. A lot of people do see some signs of life in the manufacturing sector here. The retail sector here is still under pressure, though, Tom. Five Below shares down 7% on the back of some really disappointing earnings. They're guiding down for the year and for the fiscal second quarter, saying comp sales will now have a negative sign in front of it instead of a positive sign. And the end of an era for the ticker symbol FB. Facebook, now Meta Platforms, officially switching its ticker this morning to META.
It's Facebook always. Romaine, thank you so much. Look for the close this afternoon as Romaine will dive deeper into Billy. Right now, and this is fun, Sharon Bell has an economics parchment, which is a little bit different because when you are in Bath, as they say in England, you get to go look at one of the great treasures of the United Kingdom, which is the Roman bath of the 1st century in Bath. Sharon Bell, there was inflation in the time of the Romans. There was inflation in the 17th and 18th century when they made Bath, and there's inflation now. What's different about this inflation for equity investors? There's something unique going on.
Yeah, I mean, that's an incredibly long-term perspective. I often get criticized for talking about comparisons with the 70s, let alone sort of back in the Roman times. But, you know, I think inflation in the 70s, for example, was pretty bad for equity investors. It was very bad for bond investors, completely destroyed their returns in real terms. But for equity investors, it was pretty bad too. And in fact, the only assets that did well then were gold and commodities, and commodity shares as well. So within equities, I still think commodity style shares, basic resources, materials companies, particularly China is reopening, and the energy stocks stand to gain most.
But critically, can we see corporations adapt? You've got a quality cash flow, quality profit, a very Peter Oppenheimer statement from Goldman Sachs. But can those corporations adapt and adjust to a sustained, say, 4 or 5% inflation?
Yeah, I mean, quality companies are the way we think about them, they've kind of got higher margins than the average company, which naturally means that as costs go up, they don't. A very low margin companies can easily go into loss. These companies are much most likely to. Also, actually, to be fair, in the first quarter, most companies were able to pass on a lot of these costs. Indeed, that's exactly what inflation is. If we're talking about CPI inflation going up to 10%, that is because companies are passing on the costs. So I think there is some element of companies being able to pass on these costs. And there's really kind of a bit of a barbell. It's these quality stocks where everyone wants their brands, and they've got ring fence businesses and they've got very high margins, etc. And then there's also sort of commodity style companies that are price takers, but they can make pretty good profits in this environment too.
Sharon, why is the story not only about commodities, but that rising rates in the Euro region are going to be really positive for banks that have gotten hit again and again by negative rates?
I think ultimately they will be positive for banks. I mean, the last decade has been horrendous for European banks for lots of reasons, but one of them has been disinflation, deflation, negative interest rates. They really couldn't make any margins in that type of environment. Now we're going into an environment with slightly higher interest rates potentially, and that I think will be better for banks, their net interest margins, etc. Also, banks are in a better position now because they have better capital levels. But there are some vulnerabilities. I think you were talking earlier about, sovereign problems in Europe, debt levels in Europe. We're perhaps not talking enough about that. Debt levels went up through the pandemic. They haven't come down again. Higher inflation may be a little bit helpful to that narrative, but generally that's still a big worry. Sovereign spreads rising above 200 for Italy basis points. Those types of issues are still issues for the banking sector, perhaps less than they were before, but that's still a bit of a negative.
Which perhaps is why the banking sector isn't a monolith and you can't view it as such. A Credit Suisse is very different from an HSBC, for example, or some of the other banks within Europe. How much, Sharon, are you investing, though? Are you actually trying to double down on the European bank story, given that it has been the pain trade for a past decade?
Yeah, no, completely. I think lots of people have see banks really just as a trading sector now, not one that you would like a buy and hold for a long time. But I do think that banks, they collapsed around the Ukraine wartime. Some of them were kind of very specifically exposed to Russia. They bounced a bit since then relative to the market. I think they probably got a little bit further to go, and I think they are still super valued. So I actually still quite like the banks in Europe. And as I mentioned, the materials and energy companies, all these kind of value areas, I still think have got a little bit further to go.
Sharon Bell of Goldman. Sharon, thank you. as always, Sharon Bow there of Goldman on the European equity market. We are 6 minutes away, Lisa, from that decision from this ECB. Then about 45 minutes after that, we'll hear from President Lagarde.
What's more important to you? What are you looking more for, the actual rate decision and the guidance, or really Christine Lagarde and how she messages
Well, let's
it?
go through the base case first of all. Most
Yes.
people expect today that you announce an end of QE, ends next month. What you do after that, you raise interest rates 25 basis points, you signal you'll do it again, you look around, have a look. Fine, I get all that. What I want to understand is the balance sheet. How do they make sure that things don't go wrong in the Italian debt market on the periphery? And Lisa, I think you and I are on the same page there. The forecast, could the forecast be as messy, horrible, as what we saw from the UK and the Bank of England a month or so ago?
How much flexibility do they build into this statement talking about the end of the purchases to talk about what they could reignite in terms of buying, right? And that, I think, goes to your point. How much are they going to signal that flexibility in this meeting? Because how much of it actually signal that they are going to be more aggressive with rate hikes because they're trying to get ahead of it to protect the peripheral regions?
Each central bank has got a style when they do these news conferences, and typically President Lagarde leans on a couple of buzzwords through the whole thing. And a couple of buzzwords she's been using repeatedly, Tom: gradualism, optionality, flexibility, to Lisa's point.
I would strongly suggest that the attorney from Chicago, with all of her background, including at the International Monetary Fund, John, is going to lead with optionality. You can go mathy here and say degrees of freedom, but she needs that given the fractious nature. What I want to know, John, is why don't we have a countdown clock? And folks on radio and television, we welcome you to Bloomberg Surveillance. The ECB decides.
The ECB decides. Is that the name of the show, Tom?
That's the name of the show now.
For the next 5
show
minutes.
within the show.
I was about to say for the next 3
When
minutes.
does that expire, Tom? After the decision comes out?
When we expire is the way that works.
If people had any choice on that, Tom, I imagine that'd be soon
Yes,
for us both.
that
Not
would
including
be-
Lisa, because when we get the fan mail, Bramo is always the highlight.
Oh, yeah.
How does she put up with the two of you? She
know.
leaves the kids behind to babysit you both every single morning. That's the
saw
message
that
I got.
one.
You see that one yesterday?
Yes,
I
I
know.
saw that one.
Thanks.
No.
We love her too. Futures positive, 0.5% on the S&P, and the Nasdaq 100 up by 0.5% also. Yields unchanged on a 10-year, 3.02%. The ECB up next. Euro just a bit stronger. Euro dollar positive, 0.1%, 107.30.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The European Central Bank is preparing for its first interest rate increase in 11 years. Today, policymakers are set to announce an end to large-scale asset purchases. The rate hike is expected next month. Officials are trying to bring down record inflation whilst averting more damage to an economy hurt by the war in Ukraine. President Biden called inflation the bane of the U.S. In an interview with ABC late-night host Jimmy Kimmel, he said that high food and gas prices could be offset by legislation lowering the cost of prescription drugs and childcare. Inflation has become one of the president's foremost political problems. Authorities in Shanghai are locking down part of the city again. They'll conduct a mass COVID testing drive Saturday in the first major movement restriction since the city ended a bruising 2-month shutdown at the start of June. More than 2.6 million people will be involved. And Bloomberg's learned that a consortium of Apollo Global Management and Reliance Industries has made a binding offer for the international unit of Walgreens Boots Alliance. The proposal puts a value of about $6.3 billion on the business, which runs more than 2,200 Boots drugstores across the UK. A rival group, Britain's ISA Brothers and TDR Capital, has considered dropping out. And Tesla has staged a remarkable comeback in terms of production in China. The electric vehicle maker tripled its output in May from the month previous, producing more than 33,000 cars. That is despite only recently getting its Shanghai factory back up to speed after the city's lockdowns. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Monetary policy is concerned, we have, still healthy growth, employment, and high inflation. So what we're saying is remove some monetary policy accommodation, and in those countries where there is obvious excess demand, then yes, monetary policy should be tighter.
That was Lawrence Boone, the chief economist of the OECD from New York City this morning. We are 1 minute away from an ECB rate decision, not in Frankfurt this time around, in Amsterdam. We'll get the response from Maria Tadeo in just a moment. Going into it, futures are positive 0.5% on the S&P, and the Nasdaq 100 up by 0.6%. Looking at Italian yields, essentially unchanged, coming in a couple of basis points, Lisa, at 3.35. That one to watch, along with the euro that's stronger going into this. Euro dollar up by 1/3%, 107.47.
Why aren't Italian bond yields higher? Does this indicate faith in the ECB to do something to really fortify and create some ceiling on yields, this idea that they're going to come out with some sort of program? Or is it just this idea that they're not going to be able to move as much as many people think?
Isn't that part of the language, though, this idea that we're going to have gradualism, that we're going to have flexibility, optionality? I'm unsure what kind of tightening cycle we get from this ECB. I've been really surprised by how quickly things have moved and how quickly people have got on board with this idea that they can actually do a fair bit.
Right now, we're looking at two-year German yields at the highest levels going back at one point since 2011 as people bring forward some of their expectations. What's been shocking is that inflation. It's been coming out above expectations again and again, and that is the reason why people have responded by pulling forward how much work they think the ECB is going to do.
Euro dollar 107. Here comes the decision from the European Central Bank. You get a drip feed of information. You get rates first. You get some guidance on QE. We'll get some forecasts in the news conference. Rates unchanged on the main refinancing rate at 0%, on the marginal lending facility at 25 basis points, unchanged on the depot rate at -50 basis points. Here comes some forecasts as well. Raising the inflation forecast, now predicting 2.1% in 2024. So rates unchanged, raising their baseline inflation projection up significantly. Saying this on PEP, reinvestments are flexible across time, assets, and countries. Lisa, I know that was a line that you've been looking for as well. They expect to raise interest rates again in September. That's an extra line we've just seen come across the wire right now. Lisa, I'm going to dig into the statement. So this is pretty clear. This looks like we're set up for a move here on the asset purchase program, then next on rates, and also on the asset purchase program to include that flexibility. We've had a lift to the inflation forecast. We've had a drop to the growth forecast, the 2.8% from 3.7%. And I think some people might say still at 2.8, Lisa. That's optimistic.
It's optimistic, especially given how much inflation has been going up. To me, this really confirms what we've been talking about all morning. They are expecting to move. They are expecting to monitor that inflation and have that be their primary concern, at the same time that they remain flexible to issues that might be arising in other areas of the European region in terms of staving off any kind of runaway yields, any runaway sell-off in bond prices. And that speaks directly to the Italian market, John.
Just want to go through these staff projections, Tom. Let's start there with the forecast. They see annual inflation at 6.8% in 2022. They see it dropping to 3.5% in 2023. The energy story is not promising. The growth story isn't promising either, Tom. They're looking for GDP growth at 2.8% in 22, 2.1% in 23, 2.1% in 2024. We'll get into the policy, but they're the forecasts, Tom. Clearly, a lift to the inflation forecast as expected, and a severe cut to the growth forecast as well.
Yeah,
they intend to hike rates by 25 basis points, Tom, in July. They see a move in September. A lot of what we're seeing at the moment confirming a lot of what was in that blog from the ECB President Christine Lagarde.
Right, yes,
the flexibility in the asset purchase program, though, Tom, an interesting element of the conversation over the last couple of weeks coming into this, and confirmed by some of the guidance this morning.
In the tone here, now let me do two things, John. First of all, off OECD yesterday, these are more optimistic numbers maybe than OECD. There's a lot grimmer tone, A, and then B, you're doing this in the middle of a war that maybe it's tangential to ECB, but nevertheless, there is a major war going on within the greater European territory. And you see it, John, with a nudge to weaker euro, 107 down to a barely 106 handle. I don't want to make much of it, but clearly the tone here is weaker euro.
This statement breaks it down as follows. They go through the asset purchase program, then on rates. So allow me to go to the asset purchase program. I'll read you this out line by line. In the event of renewed market fragmentation related to the pandemic, PEP, this is the Pandemic Emergency Purchase Program, reinvestments can be adjusted flexibly across time, asset classes, and jurisdictions at any time. So even though you end QE on July 1st through the Asset Purchase Program, ultimately PEP and the reinvestment of maturing bonds, Lisa, is going to be incredibly flexible. So this kind of addresses the question that people have been asking. How do they raise interest rates without damaging the Italian bond market? Here's a decision to end QE. At the same time, you've got an Italian bond market, a 10-year, up just a couple of basis points at 340. That's the concern. How do you do both at the same time? Euro-dollar falling this morning, just a little bit weaker. Euro-dollar, a break of 107. Lisa, just a couple of contradictory things to think about. How do you raise interest rates, try and support a currency, at the same time try and make sure this bond market doesn't run away from you?
And how much control can they have with purchases as we point to the JGB market? That's not a market that hasn't traded as they try to control spreads, as they try to control yields. Are we going to face some sort of similar battle? And we see that struggle as markets try to adjust to this message that the ECB is trying to bake in more flexibility for them to raise rates while controlling the peripheral region. How much control can they have through these asset purchases?
So this is a line some people have never been able to read before in an ECB statement, Tom. The last time we had a hike was 2011. Since then, clearly the outlook just was not sufficient, did not meet the threshold to increase interest rates. Here's the lead paragraph on key interest rates for the ECB. The Governing Council undertook a careful review of the conditions which, according to its forward guidance, should be satisfied before it starts raising the key ECB interest rates. As a result of this assessment, the Governing Council concluded that those conditions have been satisfied. It's been 10 years, Tom, 10 years plus, since the Governing Council concluded that those conditions had been satisfied. They have now. They're going to wind down QE. They're going to look to hike next month, Tom.
Well, and the trends here are extraordinary. First, in Amsterdam, Maria Tadeo. Maria Tadeo, what is the impact of the Bundesbank and those more conservative on these set of headlines?
Well, you know, to me, Tom, actually, there's one thing that you mentioned, and you said she's put on paper now that September hike. I think the question going into this press conference, and she's going to get hammered on this, is whether that September hike is going to be 50 basis points. Now, the other thing, you know, when it comes to the German central bank, and I think is very also something that you hear from the Dutch too and a number of other central banks in the euro area, is that the ECB needs to be much more aggressive. And the projections here actually show that the inflation print is a problem. You mentioned also that line where she says her flexibility by jurisdiction, by country. Some would tell you that is a reference to Italy. But I think when you look at the BTP, and this is a challenge for Christine Lagarde, she needs to prove that this is not just about Italy, because the European Central Bank, in theory, is not here to set policy for individual countries. This needs to be a much more comprehensive question now and a much bigger debate, not just focus on Italy on paper. If it's clear that this is now perhaps concerns about the debt situation or the fiscal situation, then that becomes a problem for Italy. And to me, the remarkable irony of this all is that we're here debating BTPs, the end of an era, and it was Mario Draghi that created in the first place that whatever it takes, and he's now the Prime Minister of Italy that's going to have to deal with this.
Maria, thank you. Maria Tadeo in Amsterdam. An extra couple of lines I want to bring to the audience if you're just tuning in. This line here on September, I think, is really important on rates. Looking further ahead, the Governing Council expects to raise the key ECB interest rate again in September. The calibration of this rate increase will depend on the updated medium-term inflation outlook. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at the September meeting. Now, I wonder if that line was included here to just alleviate some of the pressure coming from the hawks on that Governing Council, Lisa, that's been emerging over the last few months, who don't just want 25 basis point hikes. They want to go bigger than that.
The recognition of that will only ignite the trading in markets that have actually priced that in through the remainder of this year, that there will be at least 150 basis point rate hike by the ECB. Shocking to think of that, given how they have just been in negative rate territory for more than a decade. What's going to be the consequence, and how much buying do they have to do on the periphery if they go 50 basis points in one meeting?
So, Tom, rates unchanged at the ECB, but not for long. That's your headline. We're going to unwind QE, end it through the asset purchase program. They'll maintain some form of flexibility to reinvestments to address what they worry about, which is called fragmentation. You can work out what that actually means in the European debt market. They've had to cut their growth outlook, kick higher their inflation forecast, and give us some guidance on rates. And it looks like this: a 25 basis point move in July. You go again in September, it could be bigger, and then you keep hiking after that. But the words they keep leaning on are the words that President Lagarde has been talking about for a while: gradualism, optionality, flexibility. Those three words. If you wanted to play a drinking game when this news conference starts, Tom, in 37 minutes' time, I know you do, look out for those three words. I imagine you'll be drinking a lot.
To me, the single headline is the inflation adjustment here, which gets us to our esteemed guest, and that is ECB 6.8% inflation, down to 3.5% next year and 2.1% in 2024. That is a good framework to bring in the international economist at Wells Fargo, Nick Benenbrook, who is hugely qualified to speak on this. I know of no one who has consistently applied FX strategy over his career like Mr. Benenbrook. Nick, thrilled to have you with us today in the studio. Does Madame Lagarde have control of the situation?
I think she does. I mean, there's both an economic control and also a political control because of all the policymakers on the ECB, and that's where her background as a politician, I think, is so important. So that medium-term forecast at 2%, that says that, you know, the ECB has an inflation problem, but it's not as severe, I think, as, say, the United States or the UK.
This is so important, folks. I'm going to get this out front. We're going to blow the brakes here and go right through the 8 o'clock hour with Mr. Benenbrook. He's that important. We welcome you all on Bloomberg Radio and Bloomberg Television, particularly in Europe. John?
In the event of renewed market fragmentation, Nick, I'll read out this quote to you, and you tell me what you think about it. Related to the pandemic, PEP reinvestments can be adjusted flexibly across time, asset classes, and jurisdictions at any time. Talk to me about what you think fragmentation actually means and what they're trying to do here as they hike interest rates.
Well, yes, they are seeing probably more fragmentation than they would really like. As you mentioned, the Italian bond spreads relative to those in Germany have gone from about 1 percentage point out to 2 percentage points. But I really think this is about as much as they can do, this flexible reinvestment, because it would be difficult for them, for example, to be raising interest rates, which they're going to do. Some of the other options I had talked about was restarting net purchases if there was too much fragmentation, or even coming up with a whole new program to help stabilize the markets. But then you'd be sort of tightening monetary policy on the one hand and easing monetary policy on the other, and that would be extremely challenging. So I think they will go with this flexible approach for as long as they possibly can, and certainly that's going to be a very delicate balance they're going to have to walk there.
Nick, it's delicate to walk a delicate balance on the ECB Governing Council when you've got some loud hawks. And those hawks are so loud at this ECB. They don't want 25 basis point moves. They want bigger moves than that. And clearly there's this line that's been put in this statement for September that I'd love your thoughts on. They say this on the September decision: the calibration of this rate increase will depend on the updated medium-term inflation outlook. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at the September meeting. Nick, that screams to me an ECB that's trying to please the hawks and tell them if this carries on through the summer, we'll go 50.
Yes, I mean, I think it's certainly, you know, trying to, as you say, allay the concerns of the hawks. I don't know if we're going to get 50 basis points in September, though. I mean, going into today's meeting, the market was pricing 36 basis points for July. And I think pretty definitively it looks like we're going to get 25 in July. And so coming back to Tom's question, does Madame Lagarde have control of the situation? I think she does. I think she's managed to get a consensus behind that 25 basis point move. Looking at our own forecast for ECB policy, we expect 25 in July. We expect 25 in September. So if I was a voter on the ECB, I guess I would not be dissenting. I would be going with gradualism at this point.
Foreign exchange traders, I don't think, know exactly what to do with this. Basically a trading range 107 for the euro versus the dollar. Unclear of whether this will be supportive or detract if it ends up slowing growth even further with more rate hikes down the pike. What's your view on that? Do you think that more rate hikes, a more hawkish stance will be positive for the euro or negative?
I think if we were to get a more hawkish view than we got today, for example, I think it would be positive for the euro. But, you know, looking at the very near term, you know, as I mentioned, today the question was for July, do we get 25 or 50? It looks like we get 25, and that's why I think the euro's selling off just a little bit today. And so really it is going to come down to, do we see those high inflation prints? Do we see those hawkish comments? And also at the end of the day, I would say this, still the Federal Reserve moving a lot quicker. The US has a much larger inflation problem. So macroeconomic fundamentals, in addition to central bank, I still think means, you know, trend is probably for a softer euro over time.
Nick, does it matter that a lot of the inflation is driven from the energy market in Europe? I mean, certainly in the US as well, but in Europe even more so, and that really the ECB can't do much about that by raising rates?
It matters a little bit, and you know, trying to use sort of the economist trick there on you know, use both hands. You know, certainly I would say the Eurozone doesn't have as severe an inflation problem when you look at their core inflation rate of 3.8%. And, you know, typically a central bank would say, well, the underlying inflation trend is not that bad. So, you know, in some sense it maybe affects the pace at which the ECB raises interest rates. But I think there's a huge focus on headline inflation in the Eurozone as well, above 8%. And the reason being is even if all of this, inflation is being driven by energy, the fact is these oil prices are going to be at $120 a barrel or higher. So we're just going to have high inflation, even if the broader inflation pressures aren't that bad.
Nick, I want to go back to your heritage, and I think it's really important here. Roger Douglas had a New Zealand that was blowing up 20, 30, 40 years ago, and he, with his leadership, New Zealand codified inflation targeting. Right now, inflation is essentially out of control. The response here is not a rigidity or a formula of targeting like John Taylor of Stanford or what the Bank of New Zealand did. The issue here is the level of dovishness versus hawkishness. How dovish is our dovish central banks right now if they can't affect New Zealand-like targeting?
Yeah, I mean, I think you've got a point there. Certainly, overall, there is still a lot of dovishness, although there is an evolution going on, because when you look at a lot of the central banks this year, faced with, worries about slower growth or this very high inflation, they've been coming down on the side of, like, let's raise interest rates, let's try and tackle inflation. But the point you make, I think, is a very good one. These real interest rates, the policy rates are still extremely low relative to the rates of inflation. And so at the end of the day, it's certainly not an early 1980s Paul Volcker kind of a situation that we have in the United States where they're moving aggressively to just sort of squeeze inflation out of the system.
Nick Benebrook of Wells Fargo. Nick, thank you. Just want to reset for people just tuning in. Rates unchanged at the ECB, but a ton of guidance. We got some new forecasts. They had to hike their inflation forecast. They had to cut their growth forecast. This market behaved like it was actually reading the statement, which is good news, because initially the bond market was pretty contained, because the first line of the statement, asset purchase program details come before rate guidance. And on asset purchase program details on the end of QE, they baked in some flexibility, this idea that they can address fragmentation with maturing, the reinvestment of maturing assets. But then you get down to the rates line and things start to get more interesting. They're looking to hike rates next month in July, go again in September, but in September opening the door to a bigger move. And then talking about sustained but gradual increases further down the road after September as well. What's interesting about this rate guidance so far, Tom, and of course everything had changed in the news conference, you've got an ECB not just getting you set up for July, but laying the groundwork for something we haven't seen in a long, long time from this European Central Bank, a tightening cycle. It's not for me to say whether they can achieve it or not, but that's what the guidance looks like this morning. Not just an ECB getting you set for a move in July, not just an ECB opening the door for a move in September, but leaving the door open to doing more after that.
In the instant, John, the thing to me that's so important here, and I alluded to the OECD yesterday, I'd really like to do a compare and contrast of the glide path of inflation that ECB sees versus OECD, or what Gita Gopinath and IMF saw a few weeks ago. I think it's a pretty benign feel of moving from 6.8% on down. Let's do this. We're going to reset right now on radio and television. We welcome all of you this morning, worldwide, across Europe and America, to 2 days of critical economics, finance, investment, in what we do. Jonathan Farrell, Lisa Bramowitz, and myself. And John, with the ECB, we go right away to the press conference, but then on to that inflation report in America tomorrow.
We're looking ahead to that tomorrow morning, Tom. We're looking at 10-year yields right now in Italy, out by 10 basis points, pushing 350.
That's a big move.
We're through 140 on a German 10-year. And Elisa, I think that's what this speaks to, is that rate guidance. At the moment, at least, that seems to be the driving force behind some of this.
It's not necessarily the offset that could come with purchases, which raises the question of what political motivation, what political incentive there's going to be to actually engage in a much bigger bond purchasing program in the peripheral regions as they raise rates, or whether they'll be able to. And again, I go back to the Japan market. When you try to push against the grain in terms of where traders want to take prices, how successful can you possibly be? And that might be the issue also facing the peripheral region.
The ECB forecast for inflation now for 2022, Tom, 6.8%. Coming into this, it was 5.1. It was 5.1, and now it's 6.8.
Let's stop here, folks, because this is when we've got a wonderful guest to drive this forward. John, I just want to emphasize 6.8% is culturally absolutely untenable for Europe. It's different than America.
And their GDP forecast, Tom, goes from 3.7% for this year down to 2.8%. It's not looking great, is it, in 22? And in 23 at 2.1%. That's below their forecast for 23, previously at 2.8.
John, let me start the data check here with Brent crude. I got to round it up to 124 a barrel. You know, the different stories here may go up, may go down, but that stasis on hydrocarbons right now is not friendly for Christine Lagarde.
Here's the uncertain one for euro dollar. Is this rate guidance currency positive or negative? In the near term, right now, the knee-jerk response is currency positive. Just a little bit, though. Euro dollar up a couple of tenths of 1% to 107.33. We've seen things turn around in a news conference before, so I don't want to cling to this market narrative too quickly. Things can change in 30 minutes' time, but based on the rate guidance so far, Tom, that seems to be the main focus for the bond market, with yields higher in Germany and much higher in Italy.
You could take the drama of Euro-Hungarian forint, which is actually an inside baseball important pair for Europe with great weakness in Hungary. But John, I'm going to go back to Euro-Swissy right now, buttressed up near a 1.05. It's not inflammatory. It's not a breakthrough to some form of Swiss franc weakness. But nevertheless, I just want to emphasize the dynamics here into this press conference are tangible.
Tom, if there's a happy central banker, it's Mr. Jordan, the president of the SNB. I'm sure he's been waiting for this ECB to make a move for a long, long time.
We will continue here right now. Patrick Armstrong with us, Chief Investment Officer at Plurimi Wealth Management. Patrick, can you invest in Europe?
You can invest in Europe. What I did this morning is I actually shorted Italian bonds, BTPs. I do own multinational European equities, companies like ASML, which has a product which is in incredibly high demand. I own Shell. You can invest in Europe, but I think you want to think global context. I think Europe's falling into a recession. It's got a tightening central bank now for the first time in a very long time. But I don't think the U.S. falls into a recession. I think China's probably going to be enormously stimulative in the second half of this year. So if you do invest in Europe, I want to play growth in other regions, not in Europe.
Patrick, I want to talk to you about the European bond market before we go out too broadly to international equities. Do you think this is achievable, addressing eventual fragmentation if it does materialize with reinvestments of PEP at the same time to raise interest rates in the way that they're guiding us towards this morning in the statement?
Yeah, I don't think so. I think that's so small. It matters at the margin. It's designed to give the market some confidence in the periphery bonds, but I didn't realize I was betting on fragmentation. That's a term I wouldn't have used before when I shorted Italy this morning. But I think that's something done deliberately, pointing out they know there is going to be consequences to the periphery as they end their QE program on July 1st. But it's words, and reinvestment is very small compared to the bond buying program that is in place right now.
So you're shorting Italian bonds. When do you start to see value again? What is sort of the threshold at which you start to say it's a buying opportunity?
If it blows out wide versus Germany, I'm actually short Bunds, and I have been short Bunds all year. I wish I was short Italy all year as well, but I've just put Italy on. I think if we see another 50 basis points wider against Germany, I'll probably start to close Italy, because I don't think it is going to be a disaster, but I do think the market pushes for some sort of response from the ECB where they put in something maybe a little bit more meaningful to make sure that the periphery yields don't blow out wider.
In other words, a more flexible purchasing program from their PEP and how much they're going to really dive into this market. Do you think that they can be effective in actually suppressing yields in that region, moving against both the inflation as well as the higher yields in the core?
We'll see at the press conference today. It'll be very important. Draghi was the master at it, whatever it takes, using words rather than explicit policy. If Lagarde really emphasizes that we're not going to let any widening of periphery, which can have an impact on inflation, have impact on confidence, if she really stresses that we'll do whatever it takes if these kind of things start to happen. In the statement that's out there right now, it doesn't say that. It says she's aware of it. So the rhetoric and the words may have just as much importance as the policy in the coming weeks.
And Patrick, there's been so many doubts about whether the Federal Reserve can deliver on the rate hiking cycle that a lot of people are pricing. Can you run me through how likely it is that this ECB can deliver on gradual, sustained interest rate hikes?
I was surprised by that, because I didn't even think they'd want to commit themselves to that yet. I think the optionality that she's really been keen to create, she's almost given up some of that by saying this is the beginning of a gradual hiking cycle. I thought it was going to be maybe even 50 in July and then see what happens. But yeah, she set the groundwork for 25 in July, maybe even 50 in September, which I think is very unlikely. That's meant to appease the hawks, I suppose. But given where growth is, given the impacts of higher oil prices and energy prices on the European consumers and European manufacturing, I think it's going to be very difficult to get a hiking cycle started in Europe. If it does start, it's great news. Something very good has happened in the economy.
I assume you also think then their GDP forecast of 2.8% for this year is pretty optimistic, maybe overly so?
I do. I think Europe's falling into recession. I do believe Germany's committed to moving away from Russian oil and probably natural gas towards the end of the year, and that's very stagflationary. That's a huge hit to manufacturing, huge hits to jobs, and higher prices as well.
We're back to that old equity playbook, aren't we? Buy Europe, but buy companies listed in Europe that have international exposure. Is that the play now, Patrick?
That's the play for me, and that's been the play for me for quite a long time. Europe's facing a lot of issues with growth and prices, and for the first time not having negative interest rates, which may even be a positive for the banks, but I still prefer to own the bank bonds rather than the bank equities with this backdrop.
Patrick Armstrong, thank you, sir. As always, Plurimi Wealth and Patrick Armstrong going into an ECB news conference, Lisa, 21 minutes away.
James Stanley over at the Daily Fix put this out, and I thought this was interesting. The ECB taking the most dovish route when trying to sound hawkish. We'll hike in a month, and then after we'll see, right? I mean, how much is this message? And we are hearing people look at this message and say it's trying to sound hawkish, but actually has a dovish tilt to it. How do they parse that line? And I guess
What's
we'll find out.
What's the time on that note? Is it got a timestamp?
Yeah, 8:03 a.m.
Do you think he read it? I think maybe he read it. 15 minutes in? Sure, perhaps he read it. I've got some doubts as to whether people read the full.
No, he was quoting the full statement, and I think that, and honestly,
no, it's not aimed at him in general, just broadly.
And I think that he's not wrong. Some people are going to agree with that. I mean, Nick Benenbrook seemed to indicate the same thing, and that's why you're seeing such a lack of conviction around the euro trading, because it's unclear what they're saying. They're trying to basically appease every constituent here. So where does Christine Lagarde come out? Perhaps the rhetoric will be most important.
You try and please everyone. Everyone often ends up unhappy. And Tom, there's always a lot of people unhappy when it comes to European central bank policy. I'm with Patrick. Surprised they opened the door to gradual sustained stuff further down the line. That's a rate hiking cycle that we're talking about, not a couple of moves and a wait and see. That's a little bit more than that.
I'm going to go to what we saw at the Fed press conferences, and John, you allude to this important press conference in 20 minutes. It could surprise. She could cut this the other way after these statements.
At 8:30 Eastern Time. Looking forward to it. A news conference just around the corner. Looking forward to this. Have been all morning. Julian Emmanuel of Evercore. He has got a 4,300 price target on the S&P, down from 4,800. He's got a bear case in there. His bear case is 2,900 on the S&P 500. Julian Emmanuel of Evercore joins us next on Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The European Central Bank has just made it official. It will end asset purchases July the 1st and also begin raising interest rates for the first time in 11 years. Plus, the ECB boosted its inflation forecast for this year from 5.1% to 6.8%, and it lowered its growth projections for this year and next. On Capitol Hill, the House has passed a package of gun legislation that includes raising the minimum age to buy many semi-automatic rifles from 18 to 21. But the move is mostly symbolic. It will ultimately be set aside for whatever compromise plan emerges from negotiations over in the Senate. And House Democrats are taking their investigation into the January 6th riot at the Capitol to prime time. Tonight's opening televised hearing will include testimony from a police officer injured that day and a documentary filmmaker who captured the events. Republican lawmakers have planned counter-programming. And Jack Ma's Ant Group now says it currently has no plan to revive the IPO that was scuttled almost 2 years ago. Earlier, Bloomberg reported that regulators had established a team to reassess the fintech's giant share sale plans. The original Ant IPO would have been the biggest listing ever. And Target has raised its quarterly dividend by 20%. The new payout implies a yield of about 2.8%. That is a full percentage point above Walmart's yield. The move comes after Target lowered its profit outlook for the second time in less than a month. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the House for business's greatest minds.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
We're prepared for a substantial economic slowdown towards the end of this year and into next year. That's why central bankers raise interest rates, right? It is to dampen the level of economic activity, and we think they're going to be successful in containing inflation, but we think there's going to be an impact on economic growth. We don't think that it's going to be a severe recession.
No hurricanes over at Standard Chartered. That was Bill Winters there, the CEO of Standard Chartered Group. From New York City this morning, good morning. Equity futures down about 1/10%, up rather by 1/10%. Unchanged on the NASDAQ 100. A big lift in the Italian bond market. Yields higher on 10 years by 15 basis points on a 10-year, on a 2-year by 10. We'll run you through the ECB stuff in about 12 minutes' time. Tom, we've got to start with Julian Emmanuel over at Evercore. The base case was 4,800. It's now 43. The bear case is 2,900. That's a lot of downside on that bear case from Evercore, Tom.
John and Lisa want to get to that. I just want to do some internal housekeeping here on Evercore ISI. Julian Emmanuel, how does Ed Hyman's acclaimed granularity and study of the American corporate economy infect this new view that you have?
Well, what it does, Tom, is it reinforces the idea that our base case continues to be that there isn't going to be a recession. And we've had waves of concern, obviously economic hurricanes, maybe offshore, so on and so forth. But Ed's granular data says we are not at the point where there is likely to be a recession, yield curve or no yield curve. And frankly, what it does, though, is when you look at the macro environment around you, it increases the probability of a recession off in 2023.
Julian, why the change? Why the change yesterday evening?
Because really, when you look at the move off of the low on May 20th, and you think about, how these kinds of bottoms form, and to be clear, our view is that you are in the midst of forming a non-recessionary bear market bottom. That's the base view. But what we haven't seen is that fundamental catalyst, and we all know that the biggest fundamental catalyst is falling energy prices, and we look for it every day, and it is not happening. But then the other thing is volume. It tends to be when you get bottoms of that nature that you see surges in volume, real concerted buying interest. That's lacking.
Julian, the downside case, the bear case, 2,900, is that the recessionary bear case, and where does the number come from?
So basically, if you look at recession bear markets of the last 100 years, the average is down around 41%. That gets you to 2,900. We're not going there unless we get a recession.
You talk about oil being the distinguishing feature between that recession, that downside scenario, and not. What is the pain point in oil that you're looking for?
Well, so, Lisa, I think it's pretty fair to say that when you think about the consumer psychology, and look, you heard the president address it last night on late night TV, is that the psychological pain point has already arrived, whether it's $5 a gallon or whatever you want to define that as. But frankly, when you look at historical data, the longer prices stay elevated at this level, the closer you get to the actual pain point.
I couldn't believe, Lisa, what the president said last night on late night TV.
He was very real in trying to address the American people. Julian, you say that, it's about how sustained this is. What about the bull case? What has to happen in order to get to 4,800 at a time when people want to hear the bearish case and want to understand how much downside they have?
We need to see visibility into the idea that this so-called softish landing is really going to crystallize. And our fear here is that, again, there's only so much the Fed can do to get, to put a lid, and not only put a lid, but take energy prices down. And really, they can't do much at all. And that, we've seen more hawkish rhetoric out of global central banks in the last week. We're likely to see that next Wednesday. And the fear is that, that it doesn't move inflation materially lower. If you get that break in inflation and you get consumer spending to stay hold in there, that's where we get the upside.
And that's the September pause as well, Julian. Do you need the September pause to get that 4,800 bull case?
Not necessarily, and frankly, the whole concept of both volatility around the macro and economic volatility, whether driven by inventories or a number of different issues, it is such a long time between now and September. The picture is likely to look almost entirely different. So we don't know exactly what monetary policy is going to require, but we do know that inflation is going to need to turn down meaningfully without a turn down in growth.
Julian, you've got three numbers here, 4,300, 4,800, 2,900. I'll have a wager with you, $10, that the only one you get asked about today is the 2,900. Julian, thank you, buddy, as always. Julian Emanuel there of Evercore, jumping on the phone for us as he downgrades the outlook. Lisa, 2,900, the bear case, the bull case, 48, something in between, the base case, 4,300.
John, it's not a bear case, it's a Bramo case.
To your point, people want to hear the downside risk because people feel like things are heading in a negative direction. They want to understand how much protection they're going to need and what could potentially transpire to get there. If oil prices stay where they are now for a prolonged period, we could get there. That is what we were just hearing from Julian Emanuel. It's shocking to me because we hear from almost every oil analyst, with the exception of Ed Morse, that oil prices are going to stay at this level. So that's where you start to get what is the downside and where does the consumer become most vulnerable?
I'll tell you what's not staying still right now is the Italian bond market. Lisa, the drumbeat begins, it gets louder. 6 minutes away, an ECB news conference with President Lagarde, yields up 15 basis points on an Italian 10-year, on a 5-year up 17, up 12 on a 2-year note. There was a line in there about addressing fragmentation. We're going to need some more detail on that in the news conference, I think, to really temper any concerns about what could happen here. And then you've got this guidance, not just for July, not just for September, but for the size of the move in September, opening the door to something bigger perhaps. And also, just a sustained move further down the road. That's an ECB talking about a rate hiking cycle, not just a couple of hikes.
Italian bond traders are hearing that rate hiking cycle. They are not hearing the flexibility from the ECB to other bonds in other countries. That is not enough conviction to really give a ceiling to these yields.
Can that ECB president, Tom, lean into the uncertainty, the risks around that view, around that sustained tightening cycle further down the road?
You know, I'm looking at a fancy mathematical chart here of the Italian 10 here, John, and what you need to know is from the beginning of the year, you've enjoyed a price move on that piece from 100 down to 80. You've lost 20% of value arguing about the ECB. I would suggest she's got to lead with that. I should also note, based on a lot of what ifs and setups, it's a very elegant chart to be higher yield and lower Italian bond price.
Also, just a note for the ECB watchers out there. Interesting, curious that the forecasts were in the statement, because typically we have to wait for the news conference.
Yeah, explain that, Frankfurt.
Not sure, Tom.
one.
I imagine that they put that in there just to justify the rest of it. The guidance around rates and monetary policy more broadly. It's going to be an interesting one, potentially. The ECB news conference coming up with President Lagarde, full coverage right here on Bloomberg TV and on Bloomberg Radio. She might want to avoid that, Tom.
She's not going to.
Unchanged on the S&P. On the NASDAQ 100, we are just about negative. We were enjoying a small morning of gains and now just rolling over a little bit, down 0.1%. From New York, this is Bloomberg.
Estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
couple of seconds' time, we'll have a news conference with the ECB President Christine Lagarde. Before we get there, we're just waiting for some economic data in the United States. Jobless claims just seconds away. Futures unchanged on the S&P 500. Unchanged also on the NASDAQ. Briefly, we're now down about 1/10% there. Yields on treasuries tracking yields higher in Germany, in Italy. Yields on treasuries higher by 4 basis points to 3.0641% on a 10-year. Claims data due any moment. The estimate 206,000, the previous number 200K. That number not out yet. We'll wait for that before we cross over to the ECB president. Yeah. But clearly, Tom, the move in treasuries tracking what we're seeing in Germany, what we're seeing in Italy.
Yeah, 307 on the 10-year yield, make it a 306, and you get out a couple more beeps and you get through the autumnal 2018 higher yield. And, you know, again, I'm going to go, John, to the idea of a regime change. Thank you, Professor Bullard. And the idea of the regime change being something Christine Lagarde has to address. John, there are those jobless numbers.
Yeah, the wrong kind of upside surprise. Historically still very low, but 229K against an estimate of 206 and a previous number of 200K-ish as well, Lisa. So an upside surprise and the wrong kind of upside surprise for jobless claims.
It takes me back to what Rick Reeder said on your show, how he was talking about how this might be the last solid jobs report that we've seen, the one that we got on Friday, how much are companies, whether it's Amazon or even Microsoft, going to start pairing workforces that they built up for a very different economy during the pandemic. Are we starting to see that, or is this just simply a normalizing market going back to something akin to what we saw pre-pandemic?
John, very quickly here, 229 claims are getting back to a January-ish level here of this year, coming down from the pandemic vector that we saw.
A bit of movement in Amsterdam, some photos being taken. We can cross over there and catch up with the ECB President Christine Lagarde as she gives us her view on the path ahead for an ECB looking to hike interest rates. The photo's still being taken, Tom.
Yeah.
Typically, I'm usually on time. Christine Lagarde is too.
No, I thought it was some
nice. Get a few more photos in, a bit of elevator music.
No, I thought it was ABBA.
It's not Frankfurt, is it? In Amsterdam,
no,
they're just
Amsterdam.
a little bit more
doing it a little differently.
Casual.
A warm welcome.
And a warm welcome. There you go. Should we listen in now?
Today and also yesterday, the Netherlands Bank had the honor of hosting the ECB's Governing Council here in Amsterdam. It was the first time in 20 years that the Governing Council came to the Netherlands again. Today is also the first time that the ECB hosts this press conference again in physical format, and I hope it will add to the joy. Thank you. Over to you, Wolfgang.
Thank you very much, Governor Knot. We are also joined here on stage by President Lagarde and by Vice President de Guindos. This is a hybrid meeting, and for those who join us remotely, I would like to ask you, as always, to turn your camera and your microphones if you ask questions. I will now give the floor to President Lagarde. President Lagarde, please.
Thank you very much, Wolfgang, and thank you so much, Klaus. It's a real pleasure being here in Amsterdam, but we'll come to that later. Let me first wish you all in the room a good afternoon as well. The Vice President and myself welcome you to our press conference. I would like to thank President Knot for his kind hospitality and express our special gratitude to his staff and for the excellent organization of today's meeting of the Governing Council. High inflation is a major challenge for all of us. The Governing Council will make sure that inflation returns to our 2% target over the medium term. In May, inflation again rose significantly, mainly because of surging energy and food prices, including due to the impact of the war. But inflation pressures have broadened and intensified, with prices for many goods and services increasingly strongly. Eurosystem staff have revised their baseline inflation projections up significantly. These projections indicate that inflation will remain undesirably elevated for some time. However, moderating energy costs, the easing of supply disruptions related to the pandemic, and the normalization of monetary policy are expected to lead to a decline in inflation. The new staff projections foresee annual inflation at 6.8% in 22, before it is projected to decline to 3.5% in 23 and 2.1% in 24, higher than in the March projections. This means that headline inflation at the end of the projection horizon is projected to be slightly above our target. Inflation, excluding energy and food, is projected to average 3.3% in 22, 2.8% in 23, and 2.3% in 24, also above the March projections. Russia's unjustified aggression towards Ukraine continues to weigh on the economy in Europe and beyond. It is disrupting trade, is leading to shortages of materials, and is contributing to high energy and commodity prices. These factors will continue to weigh on confidence and dampen growth, especially in the near term. However, the conditions are in place for the economy to continue to grow on account of the ongoing reopening of the economy, a strong labor market, fiscal support, and savings built up during the pandemic. Once current headwinds abate, economic activity is expected to pick up again. This outlook is broadly reflected in the Eurosystem staff projections, which foresee annual real GDP growth at 2.8% in 22, 2.1% in 23, and 2.1% in 24. Compared with the March projections, the outlook has been revised down significantly for 22 and 23, while for 24 it has been revised up. On the basis of our updated assessment, we decided to take further steps in normalizing our monetary policy. Throughout this process, the Governing Council will maintain optionality, data dependence, gradualism, and flexibility in the conduct of monetary policy. First, we decided to end net asset purchases under our asset purchase program as of July 1st, 2022. The Governing Council intends to continue reinvesting in full the principal payments from maturing securities purchased under the APP for an extended period of time past the date when it starts raising the key ECB interest rates, and in any case, for as long as necessary, to maintain ample liquidity conditions and an appropriate monetary policy stance. Second, we undertook a careful review of the conditions which, according to our forward guidance, should be satisfied before we start raising the key ECB interest rates. As a result of this assessment, the Governing Council concluded that those conditions have been satisfied. Accordingly, and in line with our policy sequencing, we intend to raise the key ECB interest rates by 25 basis points at our July monetary policy meeting. Looking further ahead, we expect to raise the key ECB interest rates again in September. The calibration of this rate increase will depend on the updated medium-term inflation outlook. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at our September meeting. Third, beyond September, based on our current assessment, we anticipate that a gradual but sustained path of further increases in interest rates will be appropriate. In line with our commitment to our 2% medium-term target, the pace at which we adjust our monetary policy will depend on the incoming data and how we assess inflation to develop in the medium term. Within the Governing Council's mandate, under stressed conditions, flexibility will remain an element of monetary policy whenever threats to monetary policy transmission jeopardize the attainment of price stability. The decisions taken today are set out in full in a press release available on our website. I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Looking at the economic activity, in the near term, we expect activity to be dampened by high energy costs, the deterioration in the terms of trade, greater uncertainty, and the adverse impact of high inflation on disposable income. The war in Ukraine and renewed pandemic restrictions in China have made supply bottlenecks worse again. As a result, firms face higher costs and disruptions in their supply chains, and their outlook for future output has deteriorated. However, there are also factors supporting economic activity, and these are expected to strengthen over the months to come. The reopening of those sectors most affected by the pandemic and a strong labor market with more people in jobs will continue to support incomes and consumption. In addition, savings accumulated during the pandemic are a buffer. Fiscal policy is helping to cushion the impact of the war. Targeted and temporary budgetary measures protect those people bearing the brunt of higher energy prices while limiting the risk of adding to inflationary pressures. The swift implementation of the investment and structural reform plans under the Next Generation EU programme, the Fit for 55 package, and the Repower EU plan would also help the euro area economy to grow faster in a sustainable manner and become more resilient to global shocks. Looking at inflation now. Inflation rose further to 8.1% in May. Although governments have intervened and have helped slow energy inflation, energy prices stand 39.2% above their levels 1 year ago. Market-based indicators suggest that global energy prices will stay high in the near term, but will then moderate to some extent. Food prices rose 7.5% in May, in part reflecting the importance of Ukraine and Russia among the main global producers of agricultural goods. Prices have also gone up strongly because of renewed supply bottlenecks and because of recovering domestic demand, especially in the services sector, as our economy reopens. Price rises are becoming more widespread across sectors. Accordingly, measures of underlying inflation have been rising further. The labor market continues to improve, with unemployment remaining at its historical low of 6.8% in April. Job vacancies across many sectors show that there is robust demand for labor. Wage growth, including in forward-looking indicators, has started to pick up. Over time, the strengthening of the economy and some catch-up effects should support faster growth in wages. While most measures of longer-term inflation expectations derived from financial markets and from expert surveys stand at around 2%, initial signs of above-target revisions in those measures warrant close monitoring. Let's turn to the risk assessment. Risks relating to the pandemic have declined, but the war continues to be a significant downside risk to growth. In particular, a major risk would be a further disruption in the energy supply to the euro area, as reflected in the downside scenario included in the staff projections. Furthermore, if the war were to escalate, economic sentiment could worsen, supply-side constraints could increase, and energy and food costs could remain persistently higher than expected. The risks surrounding inflation are primarily on the upside. The risks to the medium-term inflation outlook include a durable worsening of the production capacity of our economy, persistently high energy and food prices, inflation expectations rising above our target, and higher than anticipated wage rises. However, if demand were to weaken over the medium term, it would lower pressures on prices. Let's have a look now at the financial and the monetary conditions. Market interest rates have increased in response to the changing outlook for inflation and monetary policy. With benchmark interest rates rising, bank funding costs have increased, and this has fed into higher bank lending rates, in particular for households. Nevertheless, lending to firms picked up in March, and this was because of the continued need to finance investment and working capital against the backdrop of increasing production costs, persisting supply bottlenecks, and lower reliance on market funding. Lending to households also increased, reflecting continued robust demand for mortgages. In line with our monetary policy strategy, the Governing Council has undertaken its biannual in-depth assessment of the interrelation between monetary policy and financial stability. The environment for financial stability has worsened since our last review in December 21, especially over the short term. In particular, lower growth and increasing cost pressures, as well as rising risk-free rates and sovereign bond yields, could lead to a further deterioration in the financing conditions faced by borrowers. At the same time, tighter financing conditions could reduce some existing financial stability vulnerabilities over the medium term. Banks, which started the year with solid capital positions and improving asset quality, are now facing greater credit risk. We will watch these factors closely. In any case, macroprudential policy remains the first line of defense in preserving financial stability and addressing medium-term vulnerabilities. So, summing up, Russia's unjustified aggression towards Ukraine is severely affecting the euro area economy, and the outlook is still surrounded by high uncertainty. But the conditions are in place for the economy to continue to grow and to recover further over the medium term. Inflation is undesirably high and is expected to remain above our target for some time. We will make sure that inflation returns to our 2% target over the medium term. Accordingly, we decided to take further steps in normalizing our monetary policies. The calibration of our policies will remain data-dependent and reflect our evolving assessment of the outlook. We stand ready to adjust all of our instruments within our mandate, incorporating flexibility if warranted, to ensure that inflation stabilizes at our 2% target over the medium term. We are now ready to take your questions. Thank you.
Thank you, President Lagarde. And the first question goes to Caroline Look of Bloomberg News. Caroline, please.
Good afternoon, President Lagarde. I have two questions. Firstly, one argument that you've made rather frequently over the last few months is that the euro area economy is in a very different place than other advanced economies. And even so, 3 months after the Fed started raising interest rates, you are now looking to start doing the same. So is this still about a difference, or are we talking more about a delay at this point? And second of all, could you tell us a little bit about whether this week's discussion focused at all on fragmentation risks and whether there were any new proposals made to address them? Thanks.
Thank you very much. The Governing Council, on the occasion of this meeting organized outside of Frankfurt in beautiful Amsterdam, thanks to the National Central Bank of the Netherlands, focused primarily on the challenge of high inflation facing the euro area and on taking further steps in our normalization path that we started, I remind you, back in December. So it's not a question of catching up. It's a question of using all the tools that we have in order to deliver on our mandate of price stability and in order to bring inflation down to target over the medium term. And our analysis was obviously that inflation was, as we said, undesirably high, and that we had to take the steps that I have identified in the monetary policy statement. And I would like to add that it's not just a step, it's a journey. We started back in December. We gradually, over the course of time, put ourselves in a position to move away from unconventional monetary policy, which will actually be taking place as of the 1st of July, in order to use more conventional tools, which are the interest rates. And on the issue of the interest rates, we also identified a path which is not only limited to a particular move, but a series of moves over the course of the next few months, depending on the medium-term outlook of inflation. On the second issue, we have to have the right monetary policy stance. That is critically important, and that is what we are doing with that identification of the journey that I just mentioned. But we also have to make sure that our monetary policy is transmitted throughout the entire euro area. And to that end, obviously, we need to make sure that there is no fragmentation that would prevent the adequate monetary policy transmission throughout the entire region. We have existing instruments. I think that we have described them in the past. It is obviously the reinvestment capacity that we have under the PEP, which is, I remind you, a complete reinvestment package that totals 1.7 trillion euros that will be reinvested with total flexibility if warranted across time, across jurisdictions, across products. And if it is necessary, as we have amply demonstrated in the past, we will deploy either existing adjusted instruments or new instruments that will be made available. But we are committed to proper transmission of our monetary policy, and as a result, fragmentation will indeed be avoided to the extent that it would impair that transmission.
Thank you, President. The next question goes to Mark Boinderman of NRC Handelsblatt over here.
Thank you, President Lagarde. My first question is whether today's decision. Thank you, President Lagarde. My first question is whether today's decision was unanimous. Could you give us a flavor of the discussion? And secondly, the ECB is now communicating that in September it could raise rates by more than a quarter of a percentage point. Did you consider already giving that message for the July meeting? Thank you.
Well, thank you very much for your question. And as I said, we had very productive discussions in Amsterdam, and these discussions concluded with a unanimously approved decision. And as I said, it's we are on a journey, but this is clearly an important step in that journey, given that we are actually deciding to end net asset purchases under the APP as of the 1st of July, which effectively means that we stop before for all sorts of market operation conditions. But we are also setting a path in which July and then September are the next first steps along the way of hiking interest rates. And while we intend to raise interest rates by 25 basis points in July on the basis of the assessment that we conducted today, we also indicate that, and I will read very carefully for you because it was obviously a sentence that we drafted carefully in order to capture our commitment. We also indicated that I'll read you the whole paragraph actually because it's a really important one. So we undertook a careful review of the conditions, which according to our forward guidance, you all remember the forward guidance with the three conditions, should be satisfied before we start raising the key ECB interest rates. Well, we concluded that these three conditions were satisfied. And accordingly, in line with our policy sequencing, for those of you who wonder why we didn't do it today, well, we have a sequencing in place that dictates, and we want to be predictable on that front, that we first of all stop net asset purchases and then we look at interest rate hikes. So in accordance with our policy sequencing, we intend to raise the key ECB interest rate 5 basis points at our July monetary policy meeting. And that's the September that you were asking me about. Looking further ahead, we expect to raise the key ECB interest rates again in September. The calibration of this rate increase will depend on the updated medium-term inflation outlook. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at our September meeting. That is pretty precise as a commitment, but it is also a factor of how the situation evolves. So if the medium-term outlook persists as we see it now, or even deteriorates, which of course we don't wish, but it could happen, then obviously the increment will be higher than 25. And then we go further because we take a third step along that journey to indicate what we will do beyond September, which is also the anticipation that further rates hikes will be necessary on the basis of the data that we collect. Thank you.
Thank you, President Lagarde. And the next question goes to Bart Meyers of Reuters. Bart, please. Here. You get a microphone. Yeah.
Thank you, Bart Meijer for Reuters. So just to make that perfectly clear, follow up on your last answer, does that mean that if the inflation outlook is not cut back down to 2%, that we will see a 50 basis point increase in September? And secondly, on the fragmentation. No, sorry, I lost that question. What I wanted to ask.
Take your time, you will find it.
Yes, no, that's all right. You said that you wanted to increase the rates by September. Does that mean all three rates? Thank you.
Yeah, that's a good question. I don't want to give a reading exercise because some of you occasionally comment on the fact that I read too much, but this one I really want to read it a bit because it matters and every word matters, including plural versus singular, to your point. So what we say is, looking further ahead, so today we say that, we expect to raise the key ECB interest rates, the three of them, again in September, most likely. The calibration of this rate increase will depend on the updated medium-term inflation outlook. And here's the important one. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at our September meeting. So I think that you took the example of if you are at 2.1% in 2024 or beyond, then the increment adjustment will be higher. The answer is yes.
Thank you, President Lagarde. And the next question goes to Annette Weisbach of CNBC. Annette, please, here in the middle.
President Lagarde, thank you very much for taking my question. I have one on what are you expecting in terms of time lag? If you raise rates in July, when will you see an effect on inflation and inflation expectations? And will that ultimately also mean that you have to lift rates to a new neutral rate? And that would be my second question, because I think there's a lot of guessing around what you think the neutral rate actually is. Is it 1.5? Is it 2% for the euro area? Perhaps you could give us a bit more of an insight. Thank you.
So, do we expect that our July interest rate hikes will have an immediate effect on inflation? The answer to that is no. And I would like to develop that a little bit. First of all, because of the anticipation of our monetary policy, because of the inflation and growth outlook, financing costs have already moderately but significantly increased. Whether you look at corporate bonds, whether you look at sovereign bonds, whether you look at bank, of course, those financing costs have increased. And with the signal that we're giving here, particularly concerning the short-term rates, this signal will continue to have an impact on financing costs. Now, typically, monetary policy decisions have a longer-term impact in relation to inflation itself. So we have to stay the course, be determined, committed to delivering the 2%. But we cannot expect that to happen on the 22nd of August for a decision that, 22nd of July for a decision that we would have made in July. On the other hand, because you mentioned inflation expectations, we observe that inflation expectations are well anchored. And we certainly want to indicate to those who form expectations, whether they're markets, whether they are experts, whether they're consumers, that we are determined to delivering on our target of 2% in the medium term. And therefore, expectations should absolutely remain anchored because we will deliver. Oh, the neutral rate. This is a topic that we have deliberately decided not to have on the occasion of this Governing Council meeting. And I'm sure that we will ad nauseum argue as to whether it is 0.96 or 1.97 or beyond or below or whatever. Suffice to say that the neutral rate over the course of time, for multiple reasons having to do with productivity, with demographics and all the rest of it, has gone down. But where it stands exactly, we have decided not to discuss it on this Governing Council meeting. And believe me, we had plenty to discuss. So we saved a little bit for later. And, you know, to be fair as well, it's not something that you can observe and determine with precision today. Is as you get closer, we will understand better where exactly it stands. And we will debate it. I have no illusion on that. Thank you.
Thank you. And the next question goes to Dan Balacher of Volkskrant. Dan, please.
Good afternoon. Thank you for taking my question. Is the end of the asset purchasing program a good time for you maybe to adjust the forward guiding policy? Because when it was introduced in 2013, it was meant to manage market expectations. But now it seems like the ECB would have stopped the purchases earlier, if not for the promises made, even though there was an extraordinary inflation-inducing event like the war in Ukraine. Is the tail, financial markets, not wagging the dog, the ECB, instead of the other way around? My second question is related to this one. The ECB believes inflation will fall down back to target by 2024. But for most of the past decade, the ECB also consistently thought that the inflation rate, which was then too low, of course, would converge to its target, and that also didn't happen. So how firm are your beliefs that you are going to succeed now, as historical experiences do not imply great credibility?
First of all, on the issue of forward guidance, I'm assuming that you're referring to the forward guidance relating to asset purchases. Yeah. So if you look at that forward guidance, we have actually changed it. If you recall, the forward guidance that we had referred to favorable financing conditions and to accommodative, there was a qualifier as well, but it referred to the accommodative aspect of our monetary policy. We have changed that, and if you look at the third paragraph on the second page, we do refer to the fact that we will do so for as long as necessary to maintain ample, not favorable, ample liquidity conditions and an appropriate monetary policy stance. So we take account of the change that has indeed taken place. And you're right, we are in a different universe. A lot of the tools, the forward guidance, the considerations over the last 11 years had to do with exactly the opposite movement, trying to bring inflation up because it was too low and often at risk of deflation. Now we are in the opposite situation, where inflation is too high and we need to bring it back to our target of 2% over the medium term. Now, how confident are we about our projections? First of all, I'd like to say that our staff does the best work they can do and apply their whole consciousness and professionalism to producing those projections. Second, those projections are not just the ECB. The projections that you have in front of you are the projections of the entire Euro system. So it's the ECB and 19 national central banks, including the great Bank of the Netherlands, which has actively and always actively participates in this exercise. So it's a cohesive work that is done, that is tedious, that is iterative, and that really checks everything. Third, it is clear that the massive energy prices hike and the war in Ukraine and the fast pace of the recovery have taken all forecasters by surprise. You know, I thought you would ask me a question like that. So what did I do? I looked at other, I hope I can find it now. Anyway, it doesn't really matter if I don't find it. The point being that all international institutions, all forecasters of repute have actually made the same mistake of underestimating or not anticipating some of the developments, such as the war, such as the energy crisis. Fourth point, I think we the Euro system and the ECB in particular, we are the only central bank which has gone back to the work that was done, which has looked under every stone to understand where the errors came from. And I use the word errors with some trepidation because it's misforecasting caused by very unpredictable events. 3/4 of the forecasting errors is actually attributable to energy prices, and the rest is largely attributable to bottlenecks that have lasted longer than had been anticipated. So, again, they do everything they can as well as they can. They make the same kind of forecast as other international institutions. Events that have developed are not captured in either models or sometimes just the sheer imagination of us all when we talk about the war at the doorstep of Europe. And fourth, we do the introspective exercise of trying to find out where it went wrong, and we will continue doing so in the future because we have to improve, no question.
Thank you. And the next question goes to Mark Schreurs of Börsenzeitung. Mark, please.
Yes, thanks for taking my questions. The first one is on reinvestments. In the past, you've stressed several times the importance of the stock of assets compared to the flow. Now you have reaffirmed to reinvest, especially the PEP payments, principal payments, at least until the end of 2024. That means a huge monetary stimulus for years. Is that appropriate if you, at the same time, are talking about normalizing monetary policy? And the second one, just for clarification, why do you today already exclude a 50 basis point hike in July?
On On the reinvestment policy that we decided for PEP and for the APP, both of them will now be operative as of the 1st of July for APP and has already begun for PEP. It is a matter that we will be discussing within the Governing Council, which we have decided not to debate today. We had, as I said, plenty to do already in the last couple of days, but we will be looking at it. And I have to tell you something. There are some of us on the Governing Council who will be interested not only to deploy flexibility if warranted on classes of assets by jurisdictions over temporality, but some of us are also interested in looking at how we can support the financing of the measures needed against climate change. I said already before that a green LTRO was interesting to consider. I think the reinvestment decisions that we will make in the coming months and years might also be inspired by this concern that we have. Okay? So that's point number one. Your point number two is, why not 15 July? Well, we are coming out of 11 years of no interest rate move. We are on our path to exit negative interest rates soon. It is good practice, and it is actually often done by most central banks around the world, to start with an incremental increase that is sizable, not excessive, and that indicates a path. As I said, the decision that we have made today are not just one intention of one single month of July. It's a whole journey that will take us back to the 2% target in the medium term. We also want to observe how markets are going to operate. And as I have mentioned, we couple our July determination with our September indication.
Thank you. Next question, Martin Arnold. I think you raised your hand, of the Financial Times.
I did. Thank you for taking my my two questions. Hello, Madam Lagarde. Could I ask, first of all, is this announcement today a signal that you are dropping gradual normalization in preference for a whatever it takes approach to tackling undesirably elevated inflation? And secondly, could I ask on tackling fragmentation that you mentioned earlier, the new instruments that could be designed and launched, would those only be designed and launched once the existing instruments, i.e. PEP reinvestments, have been fully utilized? Thank you.
I want to take you back to the monetary policy statement, because I think that the key principles that we will be inspired by in order to be predictable by you, but also to set the rules according to which we will proceed, are captured on the top of page 2 and say the following: throughout this process, the Governing Council will maintain optionality, data dependency, gradualism, and flexibility in the conduct of monetary policy. So, all four will matter, and there will be circumstances when one might be more important than another, and there might be other circumstances where the pecking order will change. So I think by doing that, we are trying to have as much optionality as we can, be able to use flexibility if and when warranted and necessary, be as data dependent as we have demonstrated and will continue to demonstrate, and also deploy the gradualism that will be appropriate given the circumstances. And I think in times of great uncertainty, gradualism is probably appropriate, more so than if the path is clear, well identified, and we all understand where we are heading. On the second issue, I just want to yet again come back to this issue of fragmentation, because I know that this is dear to some. I just want to reiterate that within our mandate, we are committed to preventing fragmentation risks in the euro area. Fragmented financial markets would obstruct the monetary policy transmission and undermine the possibility for the ECB to achieve its price stability mandate. And that's the reason we monitor constantly. And that is the reason we have available at hand all the dimensions of flexibility that can be applied to our reinvestment policies under the APP, under the PEP, because flexibility conditions are clearly associated with PEP to the extent that it relates to consequences of the pandemic. But we, as I said, we know how to design and we know how to deploy new instruments if and when necessary. We've demonstrated that in the past. We will do so again.
Thank you. And the next question goes to Eric Albert of Le Monde. Eric, please.
Thank you very much for taking the question. Given the scale of the inflation, it's no surprise that the ECB is acting. But still, could you explain, it's an inflation that's imported, that's mostly a tax on consumption, really. What can interest rate do against this kind of inflation? And also, could you come back a little bit on why do you not expect too much of a risk of a recession? You did explain a little bit, but could you explain on that, please?
Well, thank you for your question. It is a case that a large portion of the inflation that we have analyzed is attributable either directly or indirectly to terms of trade, what you call imported inflation, whether it is energy, exogenous bottlenecks, that is clearly so-called imported inflation. But it's not it, because we are clearly seeing an unprecedented 75% of the items considered to measure inflation being above 2%. And that applies to non-energy industrial goods, it applies to services, and it is partly a factor of the energy pass-through, but not only. Number two, we are also very attentive to wages, wage negotiations, and to the risk of second-round effect and potential spiraling. We are not seeing the risk of spiraling at all, but we are seeing wage increases that have picked up, particularly since March, and that, as we indicated in the monetary policy statement, would not be entirely surprising, whether it is by way of catch-up effects or by way of general wage increase. We're also aware that Germany, for instance, will implement the minimum wage as of October 1st. So it is largely, and certainly much more so than in the US, for instance, to come back to your questions about the difference between the EU and the US, it is more so imported inflation than it would be attributed to overheating demand, as is probably more so the case in the US. But it's spreading more broadly than strictly speaking in energy-related sectors. And then, you had another question. You know, it's a bit of a story of, on the one hand, on the other hand, the current situation of the economy. There is probably more of the negative hand than the positive hand, but we have both. And on the negative front, we clearly have the continued impact of the war, in particular, the reactivation of lockdown measures in China, which went away, then are maybe slightly coming back, the bottlenecks impact that it induces and the dampening effect it has on growth, not to mention the reduced disposable income that some of the households are suffering. But on the other hand, you have entire sectors of the economy that are recovering. And when you look at the tourism industry, the accommodation industry, hospitality, those sectors are really recovering at a fast pace. And you know, we looked at on a per-country basis at the prices of hotels, of restaurants. It is clearly on its way up with a strong demand in those sectors in particular. And we cannot exclude also, we hope, that remains to be seen, that some of the factors that have a dampening effect on growth will gradually fade a bit.
Thank you. And the next question goes to Eshe Nielsen of the New York Times. Eshe, please.
Thank you. Good afternoon. You talked of raising all three key interest rates. Is the intention to keep the spread between those consistent as they have been so far? Will that change further into the future? And then my second question is on, can you talk a little bit more about the conditions that would trigger the flexibility within a PEP? And do they have to be specific to the pandemic being the causes, or could you say that actually consequences of the war in Ukraine or some other shock that we haven't envisioned yet could also encourage that flexibility usage? Thank you.
Thank you very much for your question. In relation to the July rate hikes that we discussed, we certainly considered that the three rates would be impacted by the hike, not just the DFR. For future references, as of September, we might also apply the principle of hikes to the three, but we have not discussed that yet. And I think the intention will probably be to have a close look at that and to determine whether or not we want to just keep those spreads or return to a better symmetry between those three. That's clearly to be debated at either our next meeting or the September meeting. On the conditions that would trigger the anti-fragmentation, let's be clear. The critical point is monetary policy transmission, and we are very attentive to make sure that it transmits throughout the entire euro area. So there is no specific level of yields increase or lending rates or bond spreads that can unconditionally trigger this or that. The principle is that we will not tolerate fragmentation that would impair monetary policy transmission. And we will determine on the basis of circumstances of countries how and when that risk is likely to materialize, and we will prevent it.
Thank you very much. I would like to turn now to WebEx and take a question from a colleague in Frankfurt.
Oh, we had forgotten WebEx because you're all here, which is so much nicer.
So, Andres Stumpf of Expansion, your question, please. And please turn on your camera and your mic. Andres, for the time being, we can't hear anything.
Can you hear me now?
Yes, wonderful.
Okay, I wasn't able to unmute myself. I have another question, Madame Lagarde, about fragmentation. We are today experiencing a new sell-off in sovereign bonds, and this might point that the PEP reinvestments and maybe the ECB new commitment is not enough to prevent fragmentation. Has the ECB any news on how the new or the adjusted tool could even look like? Thank you.
Thank you very much for your question. I can only repeat what I have said, which is that we will not tolerate fragmentation that would impair the proper transmission of monetary policy throughout the entire euro area. We do have existing flexibility that is embedded in the reinvestment of our PEP in particular, and we have demonstrated in the past, we will demonstrate if necessary in the future, that we can design, we can deploy the appropriate instrument to prevent that risk from materializing. Thank you.
Thank you. And the next question will go to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Good afternoon, and thank you for taking my questions. President Lagarde, I have two questions. One is on the importance of data dependency. And looking beyond September for rate hikes, the Governing Council will adjust the monetary policy and it will depend on incoming data. Can we expect then lift-offs to come on a quarterly basis, coupled with the macroeconomic projections? And my second question is on financial stability, because you mentioned it. You mentioned that banks will be facing credit risks increased due to tighter financing conditions. How concerned are you about financial stability in a war situation? Thank you.
I have to tell you that I'm concerned about the war, full stop, but your question goes further than that, of course, and the financial stability side of the question, I will defer to my esteemed colleague, friend, and Vice President de Guindos. The first one, yes, we are going to pay a lot of attention to data, and we are considering data dependency as one of the key 4 principles according to which we will operate. And obviously, the quarterly projections that we produce are, very rich, inform our decisions best. But we cannot be unattentive to developments and to data that we continuously collect, both at the ECB and within the national central banks as well. So we are not going to put ourselves in a straitjacket of only taking decisions when we have projections. So with that, I'd like to hand you over.
Thank you very much for the question. You know that in our strategy review, we included a reference that twice per year we would include financial stability considerations in our monetary policy making. And, we did it in December, and we have done it now in June. And here, the message is quite clear. The vulnerabilities of the financial system in Europe have been defined in our financial stability review, refer to problems in terms of valuation of financial assets, in terms of margins of the banks, and in terms as well of high valuations in some spots of residential real estate. So the conclusion that we have reached, that is included in the monetary policy statement, is that in the short term, the normalization of monetary policy conditions can give rise to additional stress in the short term, but in the medium term, the tightening of financial conditions could be positive in order to try to address some of the vulnerabilities. Think about residential real estate. So, this is the main conclusion. And, we try to make an assessment that covers not only the short term, but as well the medium term.
Thank you very much, Vice President. That brings our press conference today to a conclusion. Thank you very much for coming here.
I would just like to add something, because we are here standing in Amsterdam, and my colleague Klaus Nott is with us. And for those of you interested, we had just a fantastic meeting that was organized under the auspices of the Nederlandisch Bank, under the leadership of Klaus, and it's been just a really good, fruitful, and productive experience. Geography matters, and hospitality can help a great deal. So thank you to the Netherlands, and thank you to the National Central Bank of the Netherlands.
And our next scheduled press conference is on 21st of July in Frankfurt.
Hospitality in Amsterdam is not helping out this bond market. From New York City this morning, good morning, good morning. Let's talk about this price action. We're set up as follows for the euro on euro dollar, following a decision from the ECB to keep rates unchanged, but tee us up for a move in July and maybe a bigger one in September. Euro dollar just a break of 107 at 106.89. Here's the move in the bond market. This is where things get interesting. In Germany, a 2-year yield higher by about 10 basis points. On a 10-year, just a little bit lower, higher by 6 basis points to 141. That curve flattening. This curve isn't. In Italy, what a breakout on an Italian yield curve, up by 16 basis points on a 2-year, up by almost 20 on a 10-year to 355. Let's call it 356, pushing 360. So in July, we're set up for 25 basis points. What about September? The ECB president leaving the door open to a 50 basis point move.
The answer is yes. The calibration of this rate increase will depend on the updated medium-term inflation outlook. And here's the important one. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at our September meeting.
Let's head over to Amsterdam and catch up with Bloomberg's Maria Tadeo. Maria, run me through your takeaway of the last hour.
Well,
Well, look, Jonathan, I think in many ways she just confirmed what we got from the statement, that this is the end of an era for the European Central Bank. Of course, we're heading into a 25 basis point hike in July, and there will be now another one in September. That was on paper, and she repeated that verbally. They're, of course, opening potentially the door for a 50 basis point. She did not push back against that, but I think for me, the real takeaway, and if you're listening to the number of questions, there was this idea of fragmentation. She got 4 questions of fragmentation. She repeated, we can't afford that. We're going to deal with that. We've done it in the past. We've done it in the future. But however, there was a lack of detail that I think when you look at the market reaction, especially BTPs, the spread, also the way it's moving on the German one, it was underwhelming. And the fact that she kept repeating the same answer without actual details of it, I think that was very, very underwhelming. And you're coming out of a conference where a lot of investors right now, especially if you trade the BTP, it's not obvious which way the central bank is going to go, but also how ready they are to provide this buffer, and in particular, what shape and form.
Which is why we're seeing some big moves in this bond market. Maria, great work as always. Maria Tadeo in Amsterdam with the European Central Bank on tour this time around. You heard the opening bell ring there about 40 seconds in. We're down 0.4% on the S&P. On the Nasdaq, we're down by 0.5%. No real drama here. But over in Europe, this move in Italy, in Germany, it gets your attention. It got the attention also of Mohamed Al-Arian, who tweeted the following: the more I listen to ECB President Lagarde's remarks, the more I feel that this Governing Council meeting will be remembered as marking the official recognition of a consequential secular change in both the economic outlook and the policy regime. We get lucky this morning. Mohamed joins us right now. Mohamed, let's start there. Your takeaway from the last couple of hours.
You know, it started by being a somewhat more hawkish outcome. And then the more I listened to President Lagarde, the more I realized that she was signaling this consequential change in the policy regime. This is a big deal, what went on in Europe. And I think the market reaction is indicative that the market is starting to understand that we've exited one regime and we've entered another regime. You know, if you listen to her carefully, she almost said that 50 basis points would have been the right move today if it weren't for the history of not having moved for a long time. That is quite a statement. And it opens the door, not just a little, wide open for 50 in September.
Some people will struggle with this, Mohamed, this idea that they can be gradual when inflation has an 8 handle and rates are still negative 50 basis points. And they'll only be going 25 basis points in July. So what we face, Mohamed, is Europe going through a whole summer of high inflation with interest rates still negative. Now, Mohamed, I get it. It's a big change for someone that's followed the ECB for a long time. I get all that. But when you look at where policy is relative to where the data is right now, that's a long summer, isn't it?
It is a long summer, but John, you also rightly showed and tweeted about Italian spreads, and that is what's holding them back. They really are worried about fragmentation. So they're going to have to strike that very delicate balance. As I said, I think that they would have rather go 50 than 25 in July, and they may still do it. You know, I wouldn't rule it out completely, but yes, they are late. Yes, they've got to get going, and she stressed it's a journey. She kept on talking about the journey that they're starting to embark on. So she's trying to give a very clear message that if you net present value what they intend to do, it's equivalent to moving quite a bit early on.
Should we talk about this journey together? For July, 25 basis points. For September, in the statement, this is what it said. The calibration of this rate increase will depend on the updated medium-term inflation outlook. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at a September meeting. Then they went further, Mohamed. I was surprised by this. I thought they'd tee us up for July, give us something for September, but then to say we'd see gradual and sustained hikes after that. We're now thinking about not just interest rate hikes for the first time since 2011, not just exiting negative rates for the first time since 2014. Mohamed, we're thinking about a rate hike cycle at the ECB. You and I have spent months talking about what is achievable for the Federal Reserve. Given the breakdown that we're seeing in the Italian bond market, which is recovering just a little bit on my screen at the moment, how achievable is a rate hiking cycle at the ECB, and what does it actually look like from your standpoint?
So I think it is achievable. I think it's achievable if only their own forecast is 6.8% inflation for this year. Their own forecast is 3% for next year. So they've got to move. I do think they have the tools to counter fragmentation pressure. What the market is nervous about is they didn't hear details, but they have set up mechanisms to counter fragmentation. The worry, John, is unlike the Fed, the ECB has only one objective, and that's inflation. And the real economy is going to suffer. Look, I'm willing to bet you, John, that when we get the next set of revisions, growth will come down even more than what they've brought it down. And remember, we are in mid-year. I'm amazed to see how big the revisions are for the current year, given that they're happening in June. Look what the OECD did and the World Bank did earlier this week. There's a major downward revision of growth going on around the world.
I want to speak to those revisions right now, Mohammed. As you speak, we've got them on the screen. 2.8% is the GDP forecast for this year. It's down from 3.7. The inflation forecast now 6.8. The previous was 5.1. I had a guest earlier when I asked them, Mohammed, is it achievable to get 2.8% growth in Europe this year? And they said no, recession. You've said the same thing before. These central bankers don't forecast recessions, Mohammed. They certainly don't do that if they're forecasting higher interest rates either. What do you think those revisions will look like on the growth side, coupled with the pressure on the inflation side?
So I suspect we will get a lot lower than the current 2.8% this year, with a few countries of the Eurozone in recession. Why don't they project it now? There's enormous institutional inertia. I worked in a multilateral for a long time, and I can tell you it's very hard to make major revisions unless you're in the midst of a crisis. So we should expect the next round of revisions, and that's true not just for the ECB and the Fed, but also for the OECD, also for the World Bank, to include further downwards revisions in growth and further upward revisions in inflation.
What do you think takes priority? The inflation side of the story or the growth side of the story? When they meet again in September and the revisions evolve in the way you expect them to?
Inflation for the ECB. That is their objective. That's what they're going to be judged on. They are way behind, and they've got to move. So inflation, and the tone of President Lagarde was completely different from anything I've heard from her before. This is quite a significant change in tone.
She was asked 1 million times about fragmentation, Mohammed. I wrote down some of the stuff she said. Within our mandate, we are committed to preventing fragmentation risk in the euro area. And the why, it would undermine the ability of the ECB to achieve its price stability mandate. Now, from my vantage point, others too, Mohammed, some people might sit here and say, are they contradictory goals to try and avoid fragmentation risk and also to tighten financial conditions sufficiently to bring inflation down? The ECB is saying they're not. What do you think?
I think they're not. And the phrase that you should have written down, John, and I'm sure you did, is monetary transmission. She linked the two by monetary transmission, that if you get fragmentation, you will not get the proper transmission of monetary policy. And that is correct. As I said earlier, John, I think they have the tools to counter fragmentation. So the fear of fragmentation is not going to get in the way of this journey of higher rates.
We're going to spend some time talking about the Fed in the next segment, Mohammed, but I wanted to tee it up with you, just as the ECB as a reference point. How different is it with this ECB joining the Federal Reserve in this tightening cycle in a way that it just did not play in the last 10 years? This feels so different to me. The ECB sat it out last time around. It's not this time around. The BOJ sat it out last time around. They're trying to do it again. That's an interesting element in all of this as well. But Mohammed, just your thoughts on that at the moment.
Oh, it is very different. I mean, in fact, you could argue that the ECB has leapfrogged the Fed. President Lagarde spoke about how they looked under every stone to figure out why the inflation forecasts were wrong. The Fed hasn't done that yet. The Fed hasn't explained to the marketplace why its forecasts were so wrong. She then talked about a journey going beyond September. The Fed hasn't been as explicit that their guidance is really till September. So in a funny sort of way, not only has the ECB joined the Fed, they've leapfrogged the Fed. And you saw that initial reaction in the FX market as the marketplace recognized that this was a significantly more hawkish ECB than the statement suggested. I mean, the press conference will be looked back, I think, as a seminal event.
Just watching this Italian 10-year story fade just a little bit more. We were positive more than 20 basis points on a session, now up just 15. Mohammed, I want to keep building on this with you. The ECB is playing in a rate hiking cycle in the way that it didn't with the Federal Reserve. You think this is becoming the more important story slightly, perhaps? The BOJ's not. This has consequences for foreign exchange. We're seeing this push up against dollar yen. Dollar yen through 134 overnight, seemingly at one point pushing 135. It could have consequences for the bond market in a way that we didn't see in the last cycle either. Mohammed, I've been surprised by how quickly some people have got comfortable with the idea that we might have seen a peak on a 10-year yield in early May at 320. Comparing it to what we experienced maybe in late 2018, this time around, German yields aren't sub-zero, they're positive. As you sit and look at bonds at the moment, Mohammed, how big a change is that, and how does it influence your thinking on where this bond market is going?
So I think we're having a general tightening of financial conditions around the world, and I think that's important. Yes, Japan is the outlier, but look at the functioning of the Japanese government bond market. It is not functioning well. It's clear that it is reaching the natural limits to unconventional policy. So even Japan is going to have to somehow exit from the regime that they're in. So this is a consequential change in the bond market. It's clear for what happens to the front end of curves. Once you get to 10-year or beyond, you have to worry about the growth implications. And that's why you've had this incredible volatility that we've seen in the 10-year in the US because of the different growth outlooks that have played out. John, I would keep a really, really close eye on the functioning of these bond markets because, as you know, there's three sorts of risks that the market are having to navigate. One is interest rate risk. They've navigated that rather well, not perfectly, but rather well. The second one is credit risk. They're embarking on this now. And the third one, which is the ugliest of all, and we don't want to have to navigate it, is liquidity risk.
Well, Mohammed, I'm not sure there's even a market in the JGB market in Japan at the moment, as we both witnessed this week. Another trading day. Haven't seen that this year, I don't think, so far. Another trading day of no trades whatsoever on a 10-year JGB. Mohammed, we're lucky. We're going to get another segment in with you, and we're going to talk about inflation, which is due tomorrow. Looking at this equity market at the moment on the S&P, we're down 0.5% with some movers. Just quickly, here's Abby.
John, a bit of wild action here on that ECB decision because, of course, ahead of it, the U.S. 10-year yield had been lower. At that point, tech higher. Then it shot up 4 basis points, bringing tech lower. And even though the 10-year yield is now flat, we still have big tech reverse lower. Apple down 0.8%. KeyBank also seeing signs of softening of demand in the U.S. NVIDIA, they signed a partnership with Hynix. That stock is lower, however. One outlier, Tesla, up 1.2% on some positive trends in China. And then speaking of China, Alibaba cooling off after a 28% 3-day move. Today down 4.4%, maybe because of the yield story and also the idea that there could be limited lockdowns in Shanghai this weekend. Alibaba right now down 4.4%, similar to U.S. tech right now, tech.
Abby, thank you. Coming up, inflation, top of mind.
Look, inflation is the bane of our existence. Inflation is mostly in food and in gasoline at the pump.
Except it's not, because core inflation is also running at 6%. Tomorrow, we're looking for another big print. We'll have that conversation next.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
We know that it's highly transmissible. We
We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
We're the strongest economy, and that's allowed us at least to stay on top of and a little bit ahead of what's happening around the world. Look, inflation is the bane of our existence. Inflation is mostly in food and in gasoline at the pump.
The latest read on inflation in America, 24 hours away. The administration and investors bracing for another elevated print. With more, here's Katie Lyons.
To be 8.2% on the headline for the month of May, John. And of course, even if that is a slight moderation from the prior month, when you look at the month-on-month figures, it's expected to be a higher number, about 0.7%. So prices are still climbing and wages are not keeping pace. And that's really the problem for the Biden administration, because the American consumer is feeling the pain, especially as for the last 2 months straight, the primary consumer expenses, fuel, power, and grocery store food have all been rising at double-digit annual rates for the first time since 1981. Food prices up nearly 12% in May. That's going to be one big contributor to the headline number. Another is the spike in gasoline prices. Pump prices up 8.2% last month, still climbing, now near $5 a gallon. They have more than doubled over the course of the Biden administration so far. But of course, neither gas nor food goes into that core metric. When you back those out, the print is expected to be softer, 0.5% month-on-month, 5.9% year-on-year, as you see demand moving out of goods, consumer discretionary goods, and into services. But our economists here at Bloomberg Economics, John, say that speaks to the mistake the Fed made. What started as supply-side goods-driven inflation has now widened out to services, which is stickier, and that means 50 basis points is going to be the move for maybe longer than this market expects, John.
Kelly Lyons, thank you. Still looking for a headline number with an 8 handle potentially. Month-over-month core is what this market will look at. Wall Street will be focused on, and even there, 0.5% is the estimate so far. That's elevated. We're lucky. I've said that 3 times now. 3 times a chime. Mohammed, thank you, sir, for being with us still. Let's go there. What are you looking for from CPI in the United States tomorrow?
So I have no reason to have a different forecast from the consensus of 0.5 and 0.7 month on month. But what worries me, John, and you're not going to like this because it's looking forward, the June month on month print will be worse than the May month on month print. I think those who boldly said inflation has peaked and is coming down may have to change their minds. I wouldn't surprise me if we see a headline print that's much higher than the 8.5.
Next month. Mohammed, why?
Not as early as next month, because first, the drivers of inflation are broadening, and that's due to the Fed policy mistake. Secondly, at the headline level, energy prices are going up month on month quite dramatically. And thirdly, we're seeing pressure on shelter and food. So if you look at all the components, it's way too early, unfortunately, to say that inflation has peaked. I hope it has, but it would not surprise me if we go above 8.5% on a yearly basis.
Hey, Mohammed, this is really important. I remember when you gave me the call early last year, and you said, I don't think this is transitory. This is important. I'm pushing back. And you went out there in force, and that force got more powerful as the year progressed. I get the feeling this year, Mohammed, that we still haven't totally relinquished this idea that a lot of this is temporary. I hear from a lot of guests who think that we've seen the peak, a mechanical peak year over year, and for good reason, and they think the Fed backs away in September. Are you stressing this is going to persist through the whole of this year, that we're not going to get that drop-off that so many people are hoping for, looking for?
John, if we get a drop-off, we'll get it for the wrong reason. We'll get it because of demand destruction, and that would be tragic. The last thing we need is for inflation to completely undermine the demand side, because then we have not only a price issue, but we have an income issue. And once again, it will be the most vulnerable segments of the population that get hit the hardest. So in a way, be careful what you wish for. So if you believe the labor market stays strong, wages remain buoyant and start catching up to inflation, then it's very hard to see inflation coming down. If, however, you think that we're going to have a recession, sure, inflation is going to come down, but that's not the sort of transitory inflation that anybody wants.
Can you take any confidence from the labour market prints we've had recently, Mohammed, that we've seen robust jobs growth, yet we haven't seen unemployment come lower, we haven't seen wages accelerate? Can you take any confidence? Is that any sign whatsoever that we are slowly getting the supply-side response that can alleviate some of this pressure?
Yeah, I certainly do. To be clear, recession is not my baseline. You've heard me say over and over again, it's stagflation is my baseline and recession is my risk scenario. John, the only thing I wish for on the labor market side is higher labor force participation and higher wages, believe it or not. That's the only thing that's missing. Otherwise, this labor market is very strong.
So when we wake up in September, we've had 3 more inflation prints going through the summer, and they sit down at the end of September at the Federal Reserve. Jackson Hole's behind us, all of that, Mohammed. What do you think the Fed has to confront, and how do you expect them to confront it?
I suspect first they'll be happy that most of the blame will have gone to the administration, unfairly so. You know, when I look at the mistakes made or the drivers of inflation, the administration comes 5th. However, it is the administration that's going to be blamed. So I think there'll be some relief in the Fed that people won't quite understand how much of this is a Fed policy mistake. But second, they're going to have to be much clearer about their path. And you've heard me say this, much clearer about what mistake are they willing to underwrite. Because right now, they are so late, John, that there is no first best policy response. That was last year when you and I were discussing it. Now, it's about minimizing the mistake. And they're going to have to make a choice and stick to it. The worst thing is the flip-flopping Fed. A Fed that hikes rates and then pauses in September, then starts hiking again, and then pauses again. That would just mean that stagflation would persist much longer than it needs to.
Mohammed, you were right, they were wrong. And we're lucky for a 4th time to catch up with you, sir. Thank you very much for being with us. Mohammed Al-Arian from Queen's College, Cambridge there, breaking down the latest move from the ECB, looking ahead to CPI tomorrow and looking ahead through this summer, the challenge that the Federal Reserve faces, a challenge in the minds of Mohammed and others of their own creation in some ways. Coming up, the market moving events you need to be watching. Your trading diary is up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Five minutes into the session, equities doing okay, unchanged, treading water if you will, going into CPI tomorrow at the ECB. Unchanged on the S&P 500, positive just a little bit on the Nasdaq by 0.1%. Following the ECB, rather, some of this price action settling down. CPI tomorrow is your trading diary. President Biden delivering remarks at the summit of the Americas at 2 p.m. Eastern. Then tomorrow morning, it's the main event, US CPI coming on Friday, followed by the University of Michigan Consumer Sentiment Survey. Looking ahead to next week with US PPI on Tuesday, a Fed rate decision and Chapman Pound News Conference next Wednesday. Then it's the Bank of England's turn with its own rate decision on Thursday. And finally, it's the Bank of Japan's turn next Friday. So a ton of really important central bank decisions coming next week. Before we get there, US CPI. And this country facing another headline print with an 8 handle. This market focused on the core month-over-month read, and even that is looking elevated. From New York, this is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employer's winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was a native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Gold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech in right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interests of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest flight in India is the system of caste. For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. Very good. 9th class. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, and language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings. As well as the
Connection lost.
Hey Regina, how are you? Hi Sindhu, fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, we say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. At Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities, and most of them got institutionalized now. So, for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change on that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
They're stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university, and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand, and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. You have to make sure that no combustion engines will be in the city in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore, if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year, because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you post it on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games. They're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So don't forget to smash like and subscribe and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Via and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了，你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G. And it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice: nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology. And live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高，但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the year through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. the queen of live streaming, Via. She is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes, and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan.
接下来我们真的要上火箭。
The king will be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce, and he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。 就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。 可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
里面有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to, show in some ways that they're authentic, right? So for Via and Li Jiaqi, they are able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products because to him that's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things because you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. And they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top-tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows. And we see like P&G have their own sales room, which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming owners can think about how to reach their consumers, and it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。
接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaqi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusaari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate. And that rotation extends deep down below the surface. And the waves can be very long. They can be several hundred meters long. And as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters of Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscale device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming into our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Ina Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1986, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Ina wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
Solar and wind energy were fully commercialized. There were a lot of amazing technologies implemented everywhere. I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Ina co-founded Eco Wave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station. This is the EcoWave Power conversion unit that has been operating in Jaffa Port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100 kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Ina and her team are working on another 100 kilowatt project at the Port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the success of wave energy companies today as opposed to like 20 years ago. But in the next few years or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely, wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy friendly world, we need all renewable energy sources to work together.
Who are all these people from? Who are all these people from?
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He is making you, but you're up for this one. I mean, it's corrupt. The system is...
One of the most dramatic elements was Ravinder Pasi's home being raided by court officials in Yokohama.
You scared my wife. You scared my children. I worked in Nissan for 16 years.
So Rav Pasi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn, and he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Passy. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way, it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Passy was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
It's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Harinada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian. Hello, Mr. Hadi. And he had a meteoric rise through the company. and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Harry Narder was somebody who actually recruited me into the company. So I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Harry Narder had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Harry Narder had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Pasi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because me, members of my team, were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon, I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know,
connection lost.
Amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered for me the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board, and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Goan Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who had spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama Court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? You know, this is a car company. This is not the KGB.
I think it's fair to say that Rav Pasi didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Harinata is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them.
I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera to me.
It's a very sad thing.
It's a family feud. A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name is Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against JP Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going. And I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with JP Morgan letterhead, and just started sitting at the kitchen table just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to JP Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place, the granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating them. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn.